Barry, I want to talk about your call out today and your sort of target for a dip here in the markets in Q2 or Q3. But how much of today's reaction do you think is notable?
Well, we had said within second and third quarter, the S&P 500 would dip about 6.5% to 2750. If you look at the fact that inflation's just not coming through, the real rate has crept up. And the real rate where it is in the last three-year Fed rate cycles, the last 30 years, would portend about a 17.5 multiple on this year's number. The other thing is our earnings model is $157 this year. The street's at $165. So being $8 below the street and not seeing a liftoff in the second, third, and fourth quarter, with quarterly earnings about $40 in each quarter, I think it's time to be cautious in the second and third quarters.
Steve, based on the way the Trump administration has talked about the economy and the puts and takes of trade negotiations based on how the U.S. economy is doing, can you help put this into context as far as how serious this might be for the markets and the economic impact that we could see from President Trump's, I guess, threat about Friday?
Yeah, I mean, there's a lot of different ways to put it into context. You know, trade is one piece of the growth story, probably, by the way, boosting growth in the first quarter, that 3.2% number that might have encouraged him. A lot of it came from the inventory trade side that might have been getting around it. Now, the tax cuts, by way of context, are seen adding about 0.4%. Tariffs take off about half of that, according to our CNBC Fed survey, but maybe more because some of that global slowdown, which is 0.3%, could be because of tariffs. I think what's important here, John, is that the market had these numbers dialed in for 2019. If you were to look at 2020, there is no tariff drag. So really, 79% of our respondents had seen a deal this year between the U.S. and China. And honestly, they don't really care what kind of deal. They don't really see the trade deficit, as the president does, as a big negative for the economy. They just want a deal to get it out of the way. It's 77%. Sorry about that. That think an agreement's coming, and they had no drag. What happens now is now you got to go back. You got to take your pencil out. You got to deepen, and you have to prolong the drag from trade.
Yeah, Barry, I mean, the stakes here are really, arguably, much longer term, much bigger than just a trade deficit. Coming into the weekend, the Department of Defense also published its annual report to Congress on military and security developments regarding China, a 136-page report that actually goes into a lot of depth in terms of next-generation technologies, state subsidies, IP theft, forced technology transfer, and what these longer-term implications of these policies in China mean. So when I do see something like a strong Q1 GDP number here, another strong jobs report, the fact that inflation remains pretty tepid, you have the Fed waiting and being patient. If the president was ever going to take a hardline stance on some of these major fundamental trade policies, it seems like now would be the time, right?
Yeah. You know, I remember in the mid-1980s reading some of those defense reviews of the Soviet Union, and the Soviet Union was, of course, decrepit by then and was experiencing problems. China is not the Soviet Union. So this is a new Cold War, and we do have populism. It is an enduring bipartisan political theme. I think it would be a mistake to try to understand and underestimate the current administration in terms of their trade priorities and how they view the world. When I look at the market overnight, just initially, the Shanghai fell 3 times more than the S&P futures. So the market voted on who's more affected by the trade actions. China's position is weaker. So I would expect that the administration would revisit this issue, and future administrations would be interested in it as well.
Barry, the U.S. stock market is a whole lot bigger, both in size and as a percent of the U.S. economy. So that, in fact, if you look at it as a percent of GDP, the U.S. stock market's 154% of GDP. It's just 71% of China. So I think it's not exactly correct to say, oh, their stock market fell more than ours. Ours is worth 2.3 times what theirs does. So I'm not sure that's the right metric. And Morgan, to your question, all those things seem like they're really big deals. But the president and the administration are going after the trade deficit. And that's something that a lot of economists don't see as a big deal. We buy stuff over there. We sell it over here for more, and the economy goes up. If it was just the issue of defense and security, I think the market would be on board. They're not on board with the positive outcome of of a trade deal that gets rid of the trade deficit.
Steve, the conversation has been, yes, trade deficit, but also forced technology transfer.
Sure,
IP
all that's
theft,
good.
State subsidies.
But look at the
a
tweets.
mechanism to enforce.
But look at the tweets where he talks about a $500 billion, that we're losing $600 billion a year. We're not losing it. If you have a German car, you have a $50,000 or $100,000 trade deficit with Germany, you're not losing, you have the car.
Right. Well, I mean, he also says that the Treasury's coffers are full of money from China. Obviously, the tariffs are paid by people who are importing goods and ostensibly pass that on. We can't correct every single tweet. Barry, really quick, on your call today, you say, you've said this on air before, you believe interest rates relative to neutral remain too tight. You think the Fed's in a chicken and egg problem, meaning eggs will have to break before the Fed turns chicken. 2750, when is that? Q2 or Q3, somewhere in there?
Yeah, we're looking for the global PMI and U.S. 10-year yields to fall between now and the third quarter, and that would push the market down. And then on Steve's point about the current account, capital account, I think that's all well known. But the incremental return from GDP on each dollar of additional debt has gone down over time, over 50 years. So what we're seeing is a global rebalancing of savings investment. And that is part of populism and deglobalization. And I think it is an enduring theme, economically speaking.